Trefen, and I am a public library consultant here at the Indiana State Library. This is the 2020 Bond Workshop. I want to thank you for all of your flexibility and understanding at this time. If you were previously registered for the in-person workshop, you may have received an email yesterday or today that made it look like the whole workshop was canceled, and I do apologize for that. Hopefully, you've all joined us online. The handout for today has been posted on the LDO Workshops page, and your LEUs will be available for download at the end of the session. I do want to ask all of the attendees today if you can go ahead and make sure your microphone is muted, and that way,
Go ahead.
Yeah, okay. So today we're going to be joined by Jane Herndon of Ice Miller and Ryan Fetters of Baker Tilly, and they will lead us through the bond process. Jane Herndon is a partner with the law firm Ice Miller, which has offices in Indiana, Illinois, Ohio, New York, Philly, and DC. She has served libraries as bond counsel for over 30 years, working on literally hundreds of library projects. She's also been involved with her local library, the Carmel Clay Public Library, and served as a trustee there for 16 years. She's currently on the Indiana Library Federation Legislative Committee. Jane and her law partners, Kristen McClellan and Eric Long, love working with libraries and assisting them with their projects and financing. Ryan Fetters has been a municipal advisor at Baker Tilly, formerly known as UMBA, for more than 13 years. He helps lead the firm's library finance practice and works in the areas of debt management, capital planning, and budgeting. In addition, he analyzes the financial impacts of new legislation on taxing units. Ryan has a bachelor's degree from Wabash College and a master's degree specializing in public finance and economic development from Indiana University. He is originally from Frankfort, Indiana, lives in Carmel, Indiana, and works out of Baker Tilly's Indianapolis office. All right, Jane and Ryan, are you ready?
We are. I'm going to go ahead and start us off. We're very excited to be here with you all today. Please know that you can ask questions in the chat box, and we'll try to answer those as we go. If we're not answering your question at the moment, it could be that we are planning to cover that in just a few minutes, so please be patient with us. Our contact information is also at the end of the presentation, so please feel free to contact either one of us down the road with your questions. So with that, we're going to go ahead and get started here. The items we're going to talk about today are the roles and the description of the project finance team. Sometimes we call them the working group. We're going to discuss things that you might consider as you're planning to do a project or finance a project. We'll discuss different bond structures and types of bonds that libraries can issue. We'll discuss the legal process, the approval process, including those elected boards, and then discuss the sale of the bonds and some things to consider as you sell those bonds and move forward. So what we're hoping today is you'll walk away with a better understanding of the roles of those members of the working group. We hope that you would be able to talk about the different types of bonds and processes to go forward with in a library project, things to consider from the financial perspective as you look at potential financing of projects, and the process that you would have to go through to get approval for bonds. So that's hopefully what our learning outcomes are for today. With this slide, I want to take a moment to look a little bit at the big picture. And virtually every library project goes through different phases, or goes through these same phases, from the point where you determine there may be some facility needs to the point where you're opening your new library or opening your renovated library. First of all, you have to assess those needs. And so there's always the planning of what. What will the project entail? You're then also going to go through the why. And when I say campaign, it could be as simple as perhaps getting your board all together and agreeing that these are the needs and that they want to go forward with the financing, to the point of having an actual campaign, as in a referendum or a petition remonstrance raise. I keep clicking instead of the arrow. And then you'll also go through a design phase, legal steps, financing steps, and eventually you'll get to the point where you're selling the bonds and you're actually starting the construction. The type of project you have will depend on how much time you spend in each of these phases. So for example, if the water is coming in through a hole in your roof and ruining your new computers, the planning or the what stage may be very quick. So is your why, perhaps. Getting your board on board to understand the needs may be very quick and obvious. The design and the legal steps and the financing steps in a fairly small project might also be quick. On the other hand, if it's a larger borrowing or a more significant change to your library structure or your community, that what phase may take months and in some cases years to the point where you're ready to move forward. Same thing with the campaign or the why. Again, depending on the complexity of your project, that phase may take a little bit longer along the way. But each of these phases you would go through when you are looking at a library project, and you would want to involve your working group in that. So let's go forward with that. The working group, or the professionals, are people that are there to help you with this process. We all realize that as library directors or CFOs of libraries, this is not something you do every day, and therefore we're there to help you along the way. These are services, and we'll talk about these roles in a minute, but you're not required to go through a bidding process. You certainly can if you'd like to, but unlike construction, in many ways, this is an area that you can choose these services on any basis that you would like. We would recommend that you make sure that whoever you hire in this phase, that it matches what your project needs are. So for example, it would be most beneficial to hire a financial advisor who's worked on property tax-backed library types of projects, because they do financial advising for the private industry or for even townships. That's a little bit different than what a library has to go through. And check references, as you all know, and communicate your expectations. So here's the slide showing you the types of roles that I'm talking about here when we're talking about the working group. And you'll notice at the top of the screen we have the voters up there. That's going to depend on the size of the project, and there was a time where I didn't have that on this slide. But basically the board and the director and the administration are going to drive the project team in many ways. You're going to have an architect potentially, or some kind of designer involved. You're going to have a municipal or financial advisor, which Ryan will talk a little bit more about. You may involve your local attorney, bond counsel. You may decide you want a construction supervisor in some role. There'll be a bank who acts as a trustee, a political consultant if you think you're going to need to run a referendum, and then you'd have an underwriter. Again, you're going to want to choose these people based on their experience and the relationship you have with them. It's pretty important that you have a trusting relationship with these folks. And here we've given you a little bit more detail. The architect, if you haven't done a project before, helps you determine what your physical needs of the library are, what systems need to be replaced. They help you through and do the design of the different phases of design. There's a schematic level, then a design development level, and then finally the construction plans that you put out on the street. They also help you then with the bidding process. Construction supervisor, this could be a clerk of the works. It could be a construction manager, either as your own agent to help you through the construction process, or you now could use a construction manager as contractor. Oop, I forgot about my little slides. And Ryan's going to take over this slide.
Good afternoon, everyone. I hope you can hear me. This is Ryan Fetters with Baker Tilly. To continue on with the roles of the team, we have the financial advisor, which is the role I play, which is also known as a municipal advisor. So those terms are interchangeable. And as you can see here, we help with the numbers, essentially. With the library, we help figure out what the needs are financially. We structure the financing, keeping in mind what the goals are and looking at what the existing debt, if any, is. We help and advise on interest rates, other things that people typically don't think about, perhaps, such as circuit breaker tax caps and how a project may affect both the library and the other taxing units of which you share jurisdiction. So we also present information to the board and the taxpayers to help make clear what taxpayer impact, if any, there will be. And then when we get into the sale of the bonds and how that's going to be pursued, we help prepare the official statement. We assist in a very important process called the rating process, which is basically the rating agency assessing the creditworthiness of the library and putting on the bonds a rating that investors will look at and determine whether or not that's an investment they want to make. And of course, we help conduct the sale and go through that process. And as it says here again, we're also called a municipal advisor. The underwriter is a financial institution. They are very important in the process. They are essentially the market for the bonds. They're the ones who will be, in most cases, purchasing the bonds as an investment banker and will underwrite the bonds in a negotiated sale if a negotiated sale is used. And we as financial advisor, municipal advisor, work with the underwriter in determining the current market and the estimated future interest rates. Finally, we have the trustee bank, and so depending on the type of bond, whether it's a lease financing or it's a general obligation bond, the role is a little different, but essentially this is a bank that's used, if it's a trustee specifically, it's used in a lease financing. If it's in a GO bond, it might be called a paying agent. So in the trustee, and by trustee we mean bank, they hold the proceeds and will require an affidavit for any kind of construction expenses, and they keep track of who the bondholders are and make sure that the bond payments that the library is making gets to the investors. Go ahead, Jane.
Oh, I keep forgetting I made animation. So also on your team is your local attorney. Oftentimes your local attorney can help you with some of the politics. It's not uncommon for those folks to have good relationships with your county council, the county auditor, maybe your city council. They can also help you with your library board, and in the case of a lease financing with the building corporation, which we'll talk a little bit more about. They could also help with publications, and in a lease financing they would help with the appraisal process and order title insurance. Bond counsel is the role that is the entity, and this is a role that someone like Ice Miller would play. We give an opinion at the end of the transaction to the bondholders that the bonds are valid and the library is required to basically repay the bonds or the loan, and that the interest on those bonds or loan is tax exempt to the bondholder. That's important to you from the library's perspective, because to the extent that bondholders don't have to pay taxes on the interest to the loan, then you'll get a lower interest rate. In order to give that opinion at the end, we work with your entire team along the way to make sure that the structure is legally permissible. We draft all of the financing documents, notices, resolutions, those kind of things, as well as help you through strategically thinking about a petition remonstrance process or a referendum process. And so that's generally the bond counsel role. So going on to project planning and considerations, there's different ways to focus on how you put together your project. One possible way, and one thing you'd want to look at, is basically a facility assessment. What's going on with your building? How long is the roof going to last? What's the timeline on your HVAC system? How are you using the library differently today and into the future compared to where you've used it in the past? And then come up with your facility needs based on that assessment. That's something an architect can oftentimes help you with. Sometimes we can see construction managers working with that as well. Along with that comes the idea of tax management, and Ryan's going to talk more about that. But those are the two things that we usually see driving projects: managing the tax rate and hand in hand with facility assessment. What is the need? So you're going to be looking at then, once you decide that there is some need, you're going to be hiring that team, including a financial advisor and bond counsel, and they're going to suggest one of the first steps then is to get that working group together. And that's something we would help you with. It's nothing you have to do on your own, but it usually is the director. Sometimes we see library board members participate. We probably discourage a little bit having the full library board there because we want this to be more truly a working meeting without having to worry about open door and things like that. Your architect or designer would typically participate, your municipal or financial advisor, your library counsel, and your bond counsel. And what will come out of this meeting then is basically a timeline. What are your goals? When do you want to be in the new building? How long will it take to get there? What's the legal structure? What are the financial concerns as far as tax rate and timing? And you'll have a timetable that shows you exactly what's going to happen when, as well as a financial plan on what this looks like with regard to tax rate impact. And I'm going to turn this over to Ryan.
Hey, Ryan, are you there? If you are speaking, we can't hear you.
I have a double system that just failed me on my mute. I apologize. So what I was saying is, to myself apparently, is that there are planning questions involved with all these projects. So one of these things is, of course, what is the project being contemplated? Are you going to be using, or excuse me, are you currently funding projects out of your operating? You don't have capital projects funds, but out of your operating. Are there things that perhaps you are capital projects that you could perhaps bond for as opposed to paying for out of your operations fund? So there's a list of questions here that you don't need to be an expert on. This is partly why you would hire us as your municipal advisor and bond counsel to talk through these questions. But these are the typical kinds of questions that we are going to consider at the beginning and outset of the project. So again, project scope. When we take a look at project scope, we're trying to figure out exactly what the nature is, the magnitude of what you're doing. Again, are you using operating funds for capital expenditures that perhaps you should be using debt for? So all of these items here are very important for us to know in terms of what the useful life is, because each one of these has a useful life, and we want to make sure that we are sizing the bond appropriately in terms of what that is and what other goals you may have. So right now, with each project, there's a total project cost, and sometimes what gets lost in there are some of the itemized costs, such as the soft construction costs and the costs of issuing the bonds. We're all pretty familiar with what the hard construction costs are. And I'll switch the page here. Oh, so we have a breakdown here in the blue. These are the main construction costs, the hard construction costs we're probably all familiar with. Be the construction of the bricks and the mortar, the site work, the utility relocation if that's needed, and contingency, extra funds built into the budget, so in case there are change orders or whatnot that need to occur, that those there are some extra funds to allow for that. But that only accounts for about 70 to 80% of the cost of a project. The other costs, which we call the soft costs, and the cost of issuance, are going to include architect's fees. We mentioned earlier there might be a construction manager who's overseeing the project. So printing of plans and certain types of insurance and equipment, technology, and perhaps a land purchase. But there's also the cost of issuance, and those are going to be the fees for the professionals, such as the financial advisor. You may have a library counsel involved, bond counsel, the trustee and underwriter that we talked about previously. They are going to have a fee for purchasing the bonds potentially, as well as there's costs for the official statement, which is the marketing document that the financial advisor helps put together to market the bonds. And in that, I would include what we mentioned earlier in the rating process. There would be a fee for the rating as well. And then, of course, if you had to do what's called capitalized interest, there potentially would be bond proceeds necessary to pay for interest during construction, depending on if this was a lease financing. So how do you size the borrowing? And I think Jane's touched on that here in terms of, this is a classic question of, what do we want for the library? What can we afford? And so now in the time that we find ourselves, it may be more about affordability in terms of perhaps not raising the tax rate, and trying, if you have an existing tax rate, perhaps you're trying to maintain that. And so there are challenges depending on the climate that we're in, but you always have to balance what you want with what you can afford. And of course, in that, you may have funds on hand that may be contributed to the project. So methods of financing library projects. So there are a couple of ways in which libraries typically do this, we find. They may cash fund the project. They may be able to put away money each year out of the budget and are holding that in reserve, say in an operations or a rainy day fund. And so they may just be paying for things out of the operations fund. Not every library is able to do that. And that's where the second half will come into the bonds. But there's also energy savings loans, which you may be entering into or considering anyway. But you'd want to have your bond counsel and financial advisor take a look at the parameters and the agreement to those. But essentially, in that case, you would be perhaps leasing some improvements that would be paid back by a savings on the utility bills. The second half of the slides shows the traditional method of financing capital projects, which is basically two types of bonds: the general obligation bond and lease rental bonds. And general obligation bonds are the direct debt of the library. They're a bit more efficient because they are in the name of the library, and the library pays that debt service directly. The lease rental bonds will come into play if you exceed a threshold that you have for the general obligation bonds. And in that case, you may need to issue what are called lease rental bonds. In this case, you would work with your bond counsel to set up a building corporation. And essentially, the building corporation would issue the bonds, and the library, since they are the taxing authority, would be able to levy for the debt service payments and then make those lease rental payments. Now we take a look at how the repayment of the bonds may look with the debt structuring. When we're structuring bonds, there are a couple of different methods that we use depending on your circumstances. So one aspect here under structure is a level payment, and that's where you're basically going to issue the bonds and repay the debt with the same payment throughout the repayment term, and it's going to be much like you pay your home mortgage. A wraparound structure, on the other hand, is a payment where what you're doing is you're maintaining the existing level of debt service, and maybe you still have some bonds outstanding, or you would still have bonds outstanding, and there's a little bit of capacity, say, up front on the beginning of the bond, where you would be essentially having shorter or smaller payments, and you're wrapping this around the existing debt in the attempt to maintain those level payments for the all outstanding debt. The maximum term of a bond supported by property taxes is 20 years. And again, like I mentioned earlier, we want to really match the useful life of those projects with what's being financed. For the general obligation bonds that I mentioned, there's a threshold. This is the calculation that is used to determine what your general obligation debt limit and capacity are. The first item and the most important that we need to consider here is what your net assessed valuation is. That's the basis of the calculation. And Jane can explain why this calculation is what it is. I'm just the numbers guy. So I know that we divide it by 3 and we take 2% of it to get to your general obligation debt issue limit. In this case, with the particular net assessed valuation we're showing here, we see that the GO debt limit is roughly 3.7, almost $3.8 million. Now that's the total amount just of the general obligation bond that you could issue. If your project exceeded that amount, you could issue lease rental bonds to get around that. But in fact, in this case, what's even more constraining is that there's outstanding general obligation debt. You can see there are roughly 1.25 million, and that's just the principal remaining on that outstanding debt. So we must net that out of your general obligation debt issue limit to figure out what the capacity is for GO bonds. So in this case, it will be roughly $2.5 million. Now I mentioned level debt payments and wraparounds. This is the level debt structure example. And so this is just one of many variations. In the time like we find ourselves now, we may not be able to accomplish the level debt structure just as it is here, but the point is illustrated that's important here. So you can see in the green, oops, looks like not everything came through on the PowerPoint on the slide here. But I can tell you what this is. Essentially what we have here is in the orange and in the green. It doesn't really matter that they're different bonds, but that's the existing debt. So you can see that we have existing debt that's going to run from 2019 through 2025. The blue debt, the dark blue debt, is the new bond. And in this case, I've set it up so it's a 2020 issuance. What's important to know is that when you issue bonds, the tax rate and the debt service corresponding to it come online in the year following the year of issuance. So in this case, if we issued the bonds in 2020, you can see the blue comes in on 2021. In this case, what we're showing is there are total payments of about $400,000 of the existing debt starting in 2019 and 2020. And in this case, we've kept level payments there in the blue, but you'll see it's an increase of about $50,000 in annual debt service from 2020 to 2021. So that may not be possible in this climate because that would be a tax rate increase, but it's just to show that in keeping those payments, all of those payments through 2021, from 2021 through 2039 are all the same level. And you can see that when the existing debt matures, the green bars there in 2025, that there's a drop in debt service payment. So that represents an opportunity for the library to issue debt again. That is the level debt structure. The wraparound debt structure I mentioned is, again, we have the existing debt, which is the orange and the green. And you can see, so it's going to be, I think, the same as the previous slide. And this time what we've done is, again, issue debt here in 2020. So the payment starts in 2021, but you see we have smaller payments from 2021 to 2025, and then they increase to maintain that total level of debt service beginning in 2026 through 2031. There's no increase in annual total debt service, and this is the wraparound structure. So we're keeping payments at $400,000. Tax rate management. Well, we've had a little bit of formatting issues, it looks like here. But essentially what this is to show is that, again, this is that existing debt. Okay, so these are bonds that were outstanding, issued in early 2000s, for example. So as we're looking here for tax rate management, we see that in 2021, the debt is dropping. So the point here is that this creates capacity for the library to issue debt, perhaps, obviously if there are needs, but to maintain that tax levy, depending on what that, in this case, would be $400,000. But it would match what your goals are for the debt issuance. Okay, and then here you can see what I'm talking about. Here we have the existing debt again in orange and green. The blue fills in the debt at the $400,000 level with no anticipated tax increase. And that's keeping your tax rate at the current level. This is a slide where we always have issues with whether or not you wait to let the bond roll off. And typically we don't like to see that because it makes it more challenging when you have to go through the approval processes that Jane's going to talk about, because you have to go and get approval to issue bonds. And in this case, when you let the bonds roll off in 2021, meaning that the orange is now no longer there, it's now going to be a tax rate increase if you issue those bonds in 2021, where it is only the green bar, and have the debt service come on in 2022. So we'd like to avoid that if possible. So be very wary about letting your debt payments decrease. And this is a bit of a level 201. So as I've mentioned, the tax rate comes on in the year after the debt is issued. And so thus far I've been showing bonds being issued in 2020, and then the debt payment comes on in the year after. If you are contemplating a bond issue or project, you know that you have debt rolling off, it is very important that you reach out to your municipal advisor as soon as you think that's going to happen, preferably if you can, and it's not always possible, a couple years in advance. Because what this is showing is the spend down of an operating balance. The way the DLGF calculates your levy, they take into account the amount of bonds you have, funds you have on hand prior to setting your levy. So this can in fact reduce your levy if you're not careful. If you wait until the year before your debt rolls off, or issue the debt, in the last year of the bond, you may have a slight dip in your levy. And it's not your fault, but it's the way that the DLGF budgets and takes into account the funds that you have on hand. What we're showing here in this example is, as you may be aware, older debt, you're allowed to budget for up to 50% of the next year's budget. Next year's debt service level, or debt service payment. So what we're trying to do here is avoid having the debt service levy, which is that orange line at the top. We're trying to keep that level, as you can see here. So in 2019 is actually, in this case, when we ideally issue the debt to take advantage of the capacity that would occur in 2021 when the green drops down in debt service level. So the reason we do this is because we want to avoid a dip in the levy. So essentially what we have here is, as you're moving from 50% debt to the 15% debt for new debt, we are spending down the cash balance, which is that black line, that dark line. So you can see it drops from 2019 to 2020. So that payment in the blue, which is the new bond, so the debt service on that would actually be paid out of the balance in your debt service fund, and you wouldn't levy that. So that's how we're able to maintain that orange line. The key really to this is, while that's fairly complicated, is if you think that you're going to be issuing debt or your bonds are going to have a step down in payment like you see here in the green, reach out to your municipal advisor and bond counsel and talk to them about what your options are. So we've talked about debt, we've talked about the structure and how to figure out, what you're going to finance and how you're going to structure it with your existing debt if you have any. But there's some consequences potentially to issuing debt. And one of these is, and I'm sure you're all familiar with, circuit breaker tax credits. And what circuit breaker tax credits are they are credits that limit a taxpayer's total property tax liability to a fixed percentage of the assessed value of that taxable property before any deductions. So each type of property classification here, and as you see on this slide, we have homestead as 1%. So you're capped at 1% of the gross assessed value of whatever that homestead value is. So the maximum liability in this case for a $100,000 homestead is $1,000. That's the most that this homeowner is going to pay in taxes. There's other residential that includes other residential and rental property, as well as agricultural land and long-term care facilities. They're capped at 2%. So for every $100,000, they're capped at the $2,000. And then business property, they're capped at 3%. So how are these tax credits funded? So the credits, they're funded by the reduction in the property tax revenues of all these taxing units, and it's done so in proportion to their own tax rate as a proportion of the total taxing district tax rate. And the taxing units aren't allowed to increase property tax rates in order to offset these shortfalls. So essentially, you are stuck with the tax credits, and oftentimes you're going to have to learn to live with them and tighten your budgets in order to pay for these reductions in what you plan to levy. So meet Joe taxpayer. We're going to go through an example here of what this homeowner is likely to, what he's supposed to pay in terms of his tax bill versus what he's actually going to pay, and that the taxing units, including the library, what they're going to receive out of his tax bill. So there are a lot of numbers here, a lot of columns. Let's focus on the yellow. It's the $100,000 home, 1% cap. And so we're going to focus on these numbers for this slide and the next couple of slides. The true tax value, the gross assessed value, the first row there is $100,000. So that's the value at which you could sell or buy the house. You're not going to pay taxes on that, but that is the amount that that the percentage, your tax cap, is based upon. So in this case, you're not going to pay any more. This homeowner is not going to pay any more than $1,000. This homeowner gets 3 general, and they may get more, but these are the 3 general deductions they receive in the next 3 rows. You have the homestead deduction, which is $45,000 or 60% of the gross value. It's the lesser of those. And then you're going to have a 35% supplemental homestead deduction on the net of that figure. And then you'll have, if you have a mortgage, you're going to have another standard $3,000 that comes off the gross assessed valuation. And when you sum those first 4 rows of numbers, you get to the true tax value, the net true tax value, which is called the net assessed valuation, of roughly $33,000 there. So the taxes are based on a dollar figure per $100 of net assessed valuation. So we then divide that number by $100 to get to the $300, and it's rounded here, $328. And for this particular taxing district, the tax rate is $3.50. So the gross tax bill, and this is a general example, we don't have property tax replacement credits and other things involved in this. This is just a general example for illustration. You get a gross tax bill of $1,148, okay? So we know that that's the gross tax bill, and we need to compare that to what the cap is on the $100,000 home, which we know 1% of $100,000 is $1,000, which is the next row. So the difference between the two is the tax credit, and you can see that it's a negative $148. So that's a credit to the taxpayer, meaning that's $148 the taxpayer isn't paying, but it's a loss to all of the taxing units. And you're going to share that loss with all of the taxing units in which you share jurisdiction. So we'll take a look at the next page. And I mentioned this a little earlier. The tax rate here is $3.50. We know if you see the total there, you can see we have the county, the township, the school, the library, and the city's individual tax rates coming up with the $3.50 for the taxing district. So the way that we allocate that, and we know we have $148 of circuit breaker credit due to that taxpayer on the previous slide. You can see that's the total in the far right. And we break that down among the various taxing units based upon the proportion of each of these individual tax rates with as a proportion of the total tax rate. So you can see each of the shares of the loss there. In this case, the library has one of the smaller shares because we typically see schools with, and perhaps the city with, higher tax rates. But in this case, the library would have $2.22 of loss from this taxpayer. So this slide, again, we're looking at that gross tax bill. We know that Joe owes a gross tax bill of $1,148, but he's capped at $1,000. And this is just to show how those losses translate into decreased revenue to each of the taxing units. So you can see the budgeted amounts for each of the taxing units, and those would be, so that's what they've budgeted for, and that's what they're expecting to get. But because of the circuit breaker for this particular taxpayer, they're not going to get the full amount that they budgeted. They're going to receive something less, and in this case, it's around 87% less. So each of them will have a different dollar figure because they have a different amount or different budget, but it's roughly going to be about 87% taxes they're going to collect instead of the full 100%. I would turn this back over to Jane.
Thanks, Ryan. You might ask, so what does tax credits have to do with a facility project and a bond issue? And it has to do with what process you go through, because if you're a library that's already suffering with circuit breaker loss, one of the things we'll talk about is, does this next project increase your tax rate? Because if it increases the tax rate, there's a very good chance that you're going to actually have greater losses because of circuit breaker, not only to yourself, the library, but to the city, to the school, to the township, to the county. And so that becomes an important conversation that we would have at that working group meeting. Same thing with regard to a situation when you're wrapping around debt, not as significantly, but we still want to have that conversation, because if you're already struggling, do we want to take this opportunity maybe to help with that? The only way to get tax rate outside the tax caps is to have it approved with a referendum. So library projects, in my opinion, are very difficult to get through a referendum, and we can talk a little bit more about that in a few minutes. But that is the only way to get tax rate outside the caps, and that's why you see a lot of schools putting referendum on the ballot, because they want tax rate or debt service to be outside those caps. And you also see them running, in some cases, operating referenda for the same reason. So with that, then, let's talk a little bit about the processes that apply with regard to taxpayer and voter impact or input on projects. One of the things we have to figure out is is this project that your library is considering a controlled project? And that's a sorry, I'm getting a phone call. That is a defined term in the statute, and it's defined to say a controlled project is one in which you're borrowing money. In other words, you don't have cash for it, so it's a bond or a lease bond that will cost more than the lesser of $5,350,950, that's in this year, in 2020, or 1% of your gross assessed value. And I have that number asterisk there because it's changing each year by the growth quotient. So for example, last year that number was $5,170,000. Prior to that, it was $5 million, and some of you may remember when it was in $2 million, and it was $2 million from 1995 until sometime the last 3 or 4 years. And now the legislature has allowed you to grow that number with the growth quotient each year. But you have to know your library's gross assessed value. So for example here, if you had a library with gross, not net, gross assessed value of $250 million, 1% of that is $2,500,000. What's the lesser of $5,350,950 or $2,500,000? For my example, the controlled project limit would be $2,500,000. And what we mean by controlled project is if it's less than that number, if it's non-controlled, then you don't have additional taxpayer or voter opposition process. In other words, no referendum, no petition remonstrance race. There's still plenty of hearings, but they don't have the ability to stop the project. So moving forward then, a little bit more detail on that. First column is, yes.
Jane, we have a question from the chat.
Okay.
Lori says, is that only for new debt? Isn't the existing debt service in a protected tax class? It is only subject to the 65 plus exemption.
I'll give a try to this, and then Ryan can jump in as well. New debt and old debt are subject to the caps now every place in the state. It used to be that in St. Joe County and Lake County they were not, they were outside the caps, but that has now changed so that all is, all debt, whether old or new, has to be now within the caps unless you do a referendum. And Ryan, I don't know if you want to comment on that, and I think this is the first year that's the case, if my memory serves me.
Yes, they're subject to that, but they are protected funds. So to the extent, because I see the question here about the 65 plus exemption, so that still gets applied. That still gets applied to the debt service. But to the extent that there are dollars that can eat up those credits in your operating fund, that's where the circuit breakers are going to go.
So in other words, to the library, it's still a loss.
Correct.
In dollars, but you have to pay your debt. So that is protected, but it doesn't mean that you don't have the loss. It just means you're applying that loss to your other funds, to your operations fund. Does that answer that
for
question,
example,
Lori?
Oh,
sorry, Ryan.
No, I was going to say for the example of townships where they only may have one fund, maybe they only have a debt service fund, for example. If they don't have another fund that can eat those credits, the debt service will in fact get circuit breaker credits if they have circuit breaker.
And this is the first year for Lake and St. Joe. Am I right on that, Ryan?
You are right, yes.
Okay. And that's a change, obviously, for those of you in St. Joe or Lake County. It looks like Lori's typing, so I'll keep going and then we can come back to that question if that's okay. So on the first column there, oh, there we go, redemption fund.
I'm going to go ahead and read that out loud
Oh,
so
okay.
people listening
Yeah,
to the
so it's
archive version.
possible that based on your tax rate that you are only getting circuit breaker affecting those with the 65 or over exemption. Consider yourself lucky. That probably means that your tax rate isn't high enough to hit other people's other kinds of taxpayer, if that makes sense. So that's good. That's not going to be the case in places with higher tax rates, some more inner city areas, the Muncie, Indianapolis, Anderson. That's not going to be the case in some growing communities as well. I think, Ryan, anything else you want to add to that before we move on?
No, I agree with that. It's typically your
Evansville. That would make sense. Your tax rate isn't quite as high as some other places. Okay, I'm going to go ahead and move forward then. So this chart then, the first column there is the non-controlled project. And the gross assessed value is something that your financial or municipal advisor can help you with. Also, your county should have that information available as well. So non-controlled project then is one, again, in which the taxpayers and voters don't have an official way to stop the project except coming to the board meeting and trying to get the board to vote differently. Again, it's $5,350,950 in this calendar year, or 1% of your gross assessed value. If your project total cost is higher than those numbers, then you're subject to the second column, and that is a project that might have the ability for a taxpayer to stop it through a petition remonstrance race. So petition remonstrance is a process that's unique to Indiana. It's been around since 1995, and it basically is a process in which people in support of the project carry petitions in favor into the community, and those opposed to the project carry remonstrance petitions against. Whoever gets the most voter or taxpayer signatures on those petitions wins. If the library wins, they move forward with the project. If the anti-group wins, then the project is defeated for a year. I say subject to because there's a process where you wait 30 days, and if you don't get a petition requesting this process, you can move forward with the project. And that level is the amount that is over the first column, but not as high as the third column, and that's the petition remonstrance process. And then the third column is a project that's total project cost is more than either $16,052,850, that's the number for this year, or 1% of your gross assessed value. So if you're a library that has $160 million of gross assessed value or more, Evansville, for example, I'm sure would be in that category, then your maximum project that could be subject to a possible referendum would be $16,052,000. The legislature also added another little caveat, and it says, and we don't see this as much in libraries, but if you do two controlled projects, so in other words, a project that fits in either category or column 2 or column 3, and those two together equal more than 25 million in a 365-day period, then the projects are both, the second project subject to a referendum. Again, that doesn't happen much in libraries. So let me give you some examples because I think the process makes a little more sense when you actually see some numbers. I will tell you these gross assessed values are several years old. So if you're at Park County or what, I know Cheryl's on here for Westfield or Knightstown, I know your numbers might be a little old, so bear with me. These are just examples. So let's take a look at Knightstown. 119 million in gross assessed value. And remember, our test is gross assessed value, or 1% of gross assessed value, or that 5 million number. So 1% of 119 million is 1,196,618. So if Knightstown was going to do a project of 1,196,000 or less, then that project is non-controlled, not subject to petition remonstrance. This is, and Hartford City is kind of a unique place because their 1% is small enough that it doesn't get over the 5 million number, nor, let me go back for a second, the 16 number. And because of that, there isn't really a process that is officially subject to petition remonstrance. The statute's written kind of strangely, and we typically have to have a conversation about that. But let's pick now, let's pick Westfield for a second. $5,075,000,000. 1% of their gross assessed value is 50 million. 50 million compared to 5,350,000. 5 million is the smaller number. So if their total project cost is 5,350,950 or less, it's non-controlled. If it's 5,350,951 up to the 16, which remember is the maximum, then it's subject to the possibility of a petition remonstrance race. And if the total project cost is over that 16,052,000, then it's subject to the possibility of a referendum. These numbers are again something we will talk about at that working group meeting. I always say to Ryan, and he always knows I'm going to ask, okay, what's the gross assessed value of ABC Library at that meeting? And we will actually create your own chart for you, which shows you which project amount would be non-controlled, which would be subject to petition remonstrance, and which would be subject to a referendum. And then this slide is designed to show you how those thresholds have changed over the last couple of years. As I mentioned, it was 5 million in 18. Last year it's 5,170,000, and then in 2020 it's 5,350,000. As of right now, we expect the legislature to allow the statute to continue. It's possible we'll see a place where that stops, but as of right now, the law allows that to continue. It'll be interesting to see how the growth quotient changes over time, and especially with this economy, I think we can see a place that the growth quotient won't be nearly as actually as large as it is right now. So we'll be watching these thresholds going forward. So again, subject to petition remonstrance or referendum. So let's say your library is one in which your total needs put you over that non-controlled threshold. So on my example, it's over the 5,350,000. You're a larger library. So to move forward, you would have to publish a notice of hearing. It's a 10-day notice. And now under the law, you would have to have 2 public hearings. First preliminary determination hearing, there would be a presentation on the need by you, your architect. There would be a presentation on tax rate and cost by Ryan. And then you would open that meeting up to the public and allow the public to comment or ask questions. The board would not take any action at that meeting. Then you would come back at a second public hearing, go through that same process again, open the meeting again, close it, and then at that point the board would be asked to adopt resolutions. Those resolutions establish the maximum borrowing amount. So you're going to want to make sure they're high enough that you can do the project even if it comes in a little bit higher with regard to construction bids. So it's a little bit of a balancing act. You want to have those numbers be conservative enough that you can handle if you see some unexpected things down the road, but you don't want the number so high that it causes concern in the community. We we're super happy when we ended up with these 2 public hearings because we used to just have 1. The truth is it's actually ended up being very helpful for units of government like libraries because it allows you to react. So if at that first hearing you hear concern for the public, it gives you a chance to listen to that concern and see if there's some things you can do to address it. Sometimes it's something about the project that the community's concerned about, and that's fairly easy to perhaps drop or delay to another day. Other times it's total cost, and you can always reduce the amount. You just can't increase it without starting this process over. Then after the second hearing, there would be a notice that would be published in your newspaper called a notice of adoption, and it starts the 30-day period in which voters or taxpayers can go to the auditor and pick up a petition to circulate to ask for either the petition remonstrance process, depending on the size of your project, or the referendum. The statute says that this petition has to be filed by the lesser of 500 or 5% of the registered voters in the library district. So if your library district has 10,000 voters or more, then it takes 500 voters or taxpayers to sign this petition. If you had 5,000 registered voters, it would be 250, etc. And again, that registered voter counter is something that the county clerk could help you with to determine how many registered voters there are in the library district. The truth is you don't usually think about that because your board is appointed, you're not elected, but that's how you come up with those numbers. If you get through this process and there is not a sufficient petition filed, then the library can move forward with the next steps of their project. They don't have to run the petition remonstrance. They don't have to run the referendum. So let me say this again because I have lots of clients, libraries and schools who don't understand this, and that is you could do a $50 million library project without having it on the referendum ballot if you got through this 30-day period without a petition. Now, that has a footnote on you still have to go to your elected board, but you do not have to run a referendum on any project unless this petition is filed. You see so many, especially schools, running referendum because they want to get that debt outside the caps. All right, petition remonstrance process. We talked pretty quickly about this, so I'll go through it quickly. Notice, 2 public hearings, notice of adoption, 30-day period. If you get through the 30-day period, you're good to go. If not, then you have a choice. If the petition gets filed, you can decide that you're going to basically abandon the project for a year, or you can decide you're going to go ahead and run the petition remonstrance race. You don't have to run a petition remonstrance race if you get the petition. You only have to run it if you want to move forward with the project. Same process for referendum, but in this case the petition, based on the size of your project, they're petitioning for the referendum process to apply. Again, the board can look at that application petition that got filed with the county, look at the names, and say, you know what, we don't think that we want to put this on the referendum ballot, so we're going to basically step back, slow down, and abandon the project. In the case of a referendum, it's an abandonment for 2 years for this exact project. If you go to the referendum process and you lose your project, that project is also defeated for 2 years. It doesn't mean that you couldn't come back with something smaller. We would talk with you at that time. You'd want to make it clear it's a separate project and stands alone. So a little summary slide, non-controlled project, no formal taxpayer opposition, but the debt has to be within or fit within your tax caps. Project subject to petition remonstrance race. Again, I didn't say this, but if you run the petition remonstrance race, that debt is still within the tax caps. If it's subject to referendum, you don't get the petition filed. It's still subject to the tax caps. The only way to get debt outside the tax caps is actually to run a referendum and to win a referendum. So as you look at your projects, and if you're a library that thinks that you're going to have to run a referendum, this upcoming elections become very important to you. If you were looking at a project that had to go to a referendum in 2021, there are no scheduled elections. So to the extent that were to occur, you would have to pay for those elections. 2022, everybody votes. So any of those elections, you wouldn't have to pay for those. And in 2023, it's only municipal elections. So if you were a library that's coterminous with the city or a town, then you don't have to pay. If you're a library that's larger than the city, in other words, you have property in the library district that's outside the city or the town limits, then you would have to pay for those polling places outside the limits, or outside of the city limits. So a couple things to think about as you start to go through this. As you're identifying your need, you want to think about how to engage different parts of your community, especially with regard to your elected boards. So how are you going to get input? That could be a stakeholder group of some kind that you meet and talk about your needs, get some feedback from that community group. You want to make sure it's widely represented, probably not just library users. You want some business people in town perhaps, maybe some political officials, maybe some farmers, depending on your library's makeup. You want a pretty wide variety of stakeholders. That's something your architect often will help you work through as well. I'm a big believer of individual meetings as well. I think you get, in some ways, more honest feedback in that circumstance. So that could be one-on-one meetings with the town council president or with the head of the chamber, or maybe there's a couple large farmers in town that you can go talk to. You know, whoever has the ear of many community members, that's who you want to engage and talk with. And you want to have a conversation that allows them to give you honest feedback. So it could be questions like, do you think the community would support a project of X cost and a tax rate impact of 2 cents? Or if we went forward with this project and here's what the scope would be and it's tax neutral, do you think that's something the community would support? That way you're getting buy-in from different pieces of the community, not just your library board and not just your library users. So this is the formatting's a little bit off here, but this is more thinking politically. You know, how do you have that goodwill campaign? How do you make sure the community knows all the things you are doing and the number of people that are historically coming in your doors, maybe not right now, or perhaps how many people are visiting your website. How many people are you assisting with applying for unemployment benefits and small business loans and things like that? Have your core group of volunteers. Think about people who have some political connection. Again, especially when it comes to these elected board that you're going to have to go through for approval. And then educate them. There's a lot of people don't understand how bonds and debt service fund projects, and so it's educating both your staff and, frankly, community members. Get community members into your library, again, especially those elected boards. Think about your news releases. How are you getting out the word to people who aren't necessarily in your door every day? A little bit of historical information regarding referenda. Fortunately, it's not particularly good news for libraries. We have the Jasper Library, who tried for the first time back in November of 2011 and was not successful. Hartford City tried a few years ago, ended up withdrawing the question before it went on the ballot. Johnson County, as you know, tried in 2012. They were not successful, and then Jasper did come back in November of 2016 and was successful. Their project was a little bit unique in that it was really a partnership with the city, and it was a library and a multi-use facility in many ways. It was going to have an arts and community center component. At some point it was supposed to have housing and different pieces to it. So they really had the backing of the city and the city's political machine in some ways with regard to that success. So referendum are hard to win under all circumstances, and I think they're really even tougher for libraries. I'm not trying to be not enthusiastic, but I think you've got to go into that pretty realistic. A couple things on rules with regard to referendum, just so you know, that once you hold that second preliminary determination and adopt the resolution, the library cannot promote a position on either a petition remonstrance, race, or a referendum by using their employees while they're on the clock. You can't use your library facilities, and you can't use your library funds. So at that point, it really is designed to be more of a battle between community groups, so your supporters versus those people who are opposed to the project. There's a lot of strategy and things that we can help, your working group can help you with on this if you were going down this road. I just want to make sure you're aware of it. There are a few other rules as well with regard to petition remonstrance and referendum. A person or organization that has a contract to provide goods or services to the library cannot spend money to promote. So for example, your construction manager who's helping you with the project can't write a check to buy signs that say vote yes or sign the yellow petition. Same thing with the company who maybe does your landscaping or any other vendor that you would typically think of to go to ask for money because you have a contract with them. Those are off limits with regard to spending money on the campaign, basically. Same thing with your attorney, architect, construction manager, financial advisor can't spend money to promote a position either. With regard to your library board members, they really should be your political ears and eyes, and each board's going to be different. Some of your boards I know are fantastic library supporters but aren't necessarily politically connected. Other libraries have very good connections. Library board members have good connections in the community and have a lot of political influence, and that can be really helpful. Use those library board members. This isn't supposed to be completely on your shoulders, although it's certainly going to feel that way at sometimes, but help them connect you to those centers of influence within your community. Also create a place, especially early on, that if a library board member is nervous about the tax rate impact or maybe the scope of the project, that they have a place where they can voice those concerns. You know, oftentimes library board members have the best intentions and they really care about the library, but then they group in the parking lot and talk about their concerns instead of talking to you directly. So make sure you create that environment so you can hear some of those concerns. They also should be then helping you figure out, to the extent you're going to have to run a petition, remonstrance, race, or referendum, they should also be helping you figure out who might be good community members to be involved with that. And they should help you determine what's the right project, the right process, the right cost for your community at this point in time. So the kind of things that we will also talk about at that working group meeting is perhaps you have a long list of facility needs, and is there a way for us to perhaps talk about doing those projects over time instead of having them all to be done at one time? So that might be something we discuss. Is your borrowing going to take the form of a general obligation bond, which Ryan talked a little bit about, or are you going to have to look at a different type like a lease bond, which is also called a building corporation or leasing corporation bond? We'll talk through about whether it is a controlled project. In other words, is it a possibility that you could have a petition or remonstrance race or referendum apply to the project, or is it non-controlled? Should we make it a smaller projects done over time to avoid that kind of taxpayer conversation or opposition? And what kind of tax rate impact are you comfortable with? And you probably want to have a short-term and a long-term plan. If you decide to go forth with a larger project and wait the 30-day period, we probably want to discuss what happens if you get that petition. Are you in fact going to run the petition remonstrance race, or would you prefer to step back and not move forward with the project at this time and probably then come back with smaller projects over time? You are not allowed under the law to divide a project to avoid the petition remonstrance or referendum process. So let me give you an example. What you couldn't do is you couldn't say the HVAC in the east side or east wing of our library is $5,350,000, and the HVAC in the west wing of our library, it's a large library, is $5,350,000, and each one are separate and each have their own $5,350,000, and we're going to do them all at one time. That clearly is artificially dividing a project to avoid the petition remonstrance or the referendum period process, and that isn't allowed. What you could do, though, is you could go and say, right now we can afford, because of tax rate management, $4 million, so we're going to do as much of the project as we can afford for $4 million. You're going to talk to your financial advisor. You're going to say to Ryan, we don't want to leave room in our plan so that 3 years down the road, we can come back and do the rest of the roof. We'd have to bid it separately for construction purposes. We would go through this process again, but we want you to leave a space in our financial plan so that we could do an additional project at that time and keep it tax neutral. I hope you can see how those two things are different. In one case, you have a lot of facility needs and you're doing the projects over time. And the other case, you're doing a project at one time and you've just artificially divided it. And that's the kind of conversation, again, we would have at that working group meeting to back up and put in place the facts to demonstrate separate projects. So let's talk for a second about method of financing or types of financing. I laughed here when I did a search for bonds. If you notice, I got books, and they're bond books, basically, James Bond books. So I decided to put that in there, so I thought that was cute. And then you also have the option of a lease agreement or lease bonds. So as you heard, general obligation bonds are subject to that constitutional debt limit. With general obligation bonds, the library is the actual borrower. You, the library, issues the bonds, you build your new building, renovate your building, whatever. And those bonds are secured by the full faith and credit of the library district's property taxes or assessed value. And that's why you have this formula here that Ryan went through. Libraries obligated to repay. They must be competitively bid, and Ryan will talk a little bit more about that. They are a little easier, a little fewer steps. They're a little less expensive, but they use your debt capacity. And so there are some projects that you have that just don't fit within that the debt capacity that your library has. So when that happens, we look at an alternative type of borrowing, and those are called leases, building corporation, or leasing corporation bonds. With those types of bonds, you form a not-for-profit leasing or building corporation. It's made up of community members, usually 3 to 5. They actually issue the bonds. And they take those bond proceeds and they build your library, renovate your library, and lease it back to the library corporation or to the library. And the lease payments on that that the library makes to the leasing corporation basically equal the principal and interest on the bonds. This is a structure that the Indiana Supreme Court blessed back in the 50s, and they said that these leases are not subject to the constitutional debt limitation. And part of the reason is that you only are required to make your lease payments to the extent that the facility is available for use and occupancy. So this process, many units of government across the state uses. Many libraries have used this mechanism. So do schools, so do cities. And so these type of lease bonds are very well accepted. And in fact, I think Ryan would probably tell you they trade in the market very similar to those general obligation bonds as well. So there's no debt limit with these that you have to worry about. There could be some marketing limits. In other words, if you had so much debt compared to your assessed value, there could be a place where investors had some concerns. Ryan can talk a little bit more about that. They take a little bit more time to get through the process. They're a little bit more expensive because with lease bonds, you're actually mortgaging the library, and that library building is the security for the bonds. So you have a legal description. There's title insurance. There's appraisals that have to be done. You can negotiate or competitively sell the bonds. Again, Ryan will talk a little bit more about that. But you got another entity that you've got to deal with, this building corporation. They will have to meet. You'll have resolutions for them to adopt as well. And so there's a little bit more expense and time and hassle with the lease financing. So we always start with the option of a general obligation bond, but if your project doesn't fit in your constitutional debt limit, then we move on to the discussion of the lease bond. Everybody's favorite topic, elected board approval. So as many of you know, this has been in place for, I don't know, 15 years now or so, 10 to 15 years. It used to be that libraries were able to borrow without having to go to an elected board. I wanted to take a second to look at your, compare the budget process of the elected board approval versus the bonds, because they're different statutes. So after Senate Bill 410 this year, you have, it's actually a little bit more straightforward with regard to which entity a library is supposed to go through for your binding approval. So the first time or first situation that you might have to go to binding budget approval would be if your budget is greater than the growth quotient. And in that case, you would look at your net assessed value, and you would say, is 50% or more of the library's assessed value outside the city limits? And if it is, then you go to the county council. If more than 50% of the library's assessed value is within the city limits, then you go to the city or the town. If you have a library that's in more than one county, then the county council that in the county in which the most of the library's assessed value is located is where you would go. And I think many of you probably are in the process of filling out that form that's now required to actually select your elected board. And then in the bottom half of the page, we have that second piece, which was what Senate Bill 410 clarified. And that's the one that if your tax funds as of December 31st are more than 150% of the next year's budget, then you would be in a situation where that the elected board may choose to have binding review of your budget. And as I think many of you know, that elected board would have to adopt a resolution after notice, after a public hearing by July of the year in order to choose to do binding review. And again, the statute is pretty nice and clear now. It basically is just where is your assessed value. And I think I said net assessed value. The statute just says assessed value. So that's actually pretty straightforward. Unfortunately, bond approval is not quite as straightforward. I wish they had changed this statute as well, but they didn't, and so it's written a little bit convoluted. So anytime you have bonds or leases, it does not include tax anticipation warrants. So for some of you who are considering that, especially this year, no, it looks to us like that does not include those tax anticipation warrants. You would look to see, again, where are your parcels? Now here it's using the word parcels versus assessed value. So it's how many parcels are within the city limits are the library, and how many parcels in the library district are outside the city limits. So you're going to need to know that. And then the statute says if your library district assessed value is basically located entirely within the city or the town limits, you're easy. You go to the city council. If the library was originally established by the city or town and the parcels are 50% or more within the city-town limits, you go to the city and town. Now, I don't know if any of you've dug down into your library's history to try to figure out why and how it was originally established. It isn't always clear. I know the state library has a lot of those records and can be really helpful in that, but unfortunately it's not always clear. So if you don't fit within A or B, then you get down to the bottom there and more of your parcels are outside the city limits, you go to the county council. So like I said, it's not as clear, frankly, as the other statute. I hope eventually we get to the place where the bond approval is a little bit clearer, like the budget approval. Yeah, I see Lisa talking about how difficult it was with regard to digging and finding that information. It'll be also interesting that you have a situation where you're going to have now an elected board who, frankly, you filled out this form saying they're your elected body, and they're going to expect you to come to them for both budget and bond things, and yet this law might say it should be somebody different. So we'll have to work through that as we go. I realize the statute is not particularly clear, and frankly it can be kind of hard to maneuver. The other thing that is a little bit difficult is the additional appropriation process. The statute indicates that bond proceeds are supposed to be information only to the DLGF. So usually for all other units of government, when we do an additional appropriation process for that unit of government, we have them advertise, hold the additional appropriation hearing, and then send that information on to the DLGF as a reporting only situation, which is different than when you're appropriating tax dollars. Bond proceeds are different. Where there's been some confusion is that the DLGF has some memos out there that infer that additional appropriation of bond proceeds for libraries are actually supposed to go to this elected board also. We've had some conversations with the DLGF about that, and in fact, back before all this happened a couple months ago, met with them and asked this exact question, and they were going to look into that, so we're hoping hoping we get some clarification here soon. Again, that's a topic that we tend to talk in detail with our clients about. If you're going to binding review as part of your bond project anyway, and there are some times when you would need to do that, we just have the additional appropriation held by the elected board in addition to the library board. If you're not, we talk through it and talk about the risks and the benefits. Sorry, this area is confusing. Frankly, the statutes are a little bit confusing. With that, I'm going to turn it back over to Ryan to talk about this.
Thank you, Jane. I might just add to that discussion on getting the approval with the fiscal body that Jane and I, or your financial advisor and bond counsel, are happy to attend those with you. Because I know we've been through many of these, and it's not uncommon that you have to go in front of the council more than once. And we mentioned circuit breaker earlier with the discussion there. That's typically something they're very interested in, is finding out how the new debt is going to potentially impact the circuit breaker, both of, well, primarily them, but also the other taxing units. So after all those approvals that Jane discussed, are satisfied and we get the green light to go ahead, we move on to planning for the sale of the bonds. So there's pre-sale activities and post-sale activities. And so as we're gearing up for this, as your municipal advisor, we're working in conjunction with your bond counsel and the other players that Jane mentioned. Some of them are included depending on whether it's a competitive sale or a negotiated sale. So it really just depends on the method of sale there. But we do need to prepare a marketing document. And typically, that's a document that's going to go out to the banks to advertise and give information about the plan for financing and then information about the library. We will make a determination in conjunction with the library as to whether or not a bond rating might be necessary. And so that always depends on what the market conditions are and the size of the bond and the creditworthiness of the library and what you're trying to accomplish. So that may or may not be applicable. And then we're going to determine a method of sale. And as Jane, I believe, mentioned, is that if it's a general obligation bond, the answer is easy. It's a competitive sale at this point. If it is a lease rental bond, then we can talk through the positives or the pros and cons, or trade-offs rather, of whether you want to competitively bid that lease rental bond or if you want to negotiate that with one bank, an underwriter. And then, of course, we have the bond closing, which would be when all the documents are signed and the funds change hands from the banks to the library or building corporation. So the preliminary official statement, this is the general document we typically use. It is a marketing tool, and it's going to give the purchasers information on the project. So what is the project going to fund? It's going to show how the bonds are going to be structured. We've talked about whether it's a level repayment or it's a wraparound your existing debt structure. The security for almost all of the bonds you would be issuing would be property taxes, so we'll go in depth on that. And then it will provide the legal opinion that Jane talked about that will state that these bonds are valid and binding and that they are tax exempt. And then again, this is important information specifically in what's typically called the general information section. This is information specific to the libraries. It's going to talk about your services, your administration, your circulation, and library statistics. It's also going to look and show your finances so that the rating agency can determine the creditworthiness of the library and assign a grade, so to speak, a rating. And then, of course, this is required for bond issuances of $1 million or greater. So if it's not a general obligation bond, if it's a lease rental bond, we have some more discretion in terms of how this is going to be sold. So the methods of sale are going to be, are you going to bid this competitively? And what that means is that it's essentially an auction. So we prepare the official statement ahead of time, and after review through the working group, we send this out to banks a couple of weeks ahead of the date targeted for the sale. And essentially it's an auction where on the day of the sale we take bids on the interest rates on each of the maturities of the bond. And so the winner is the one or the bank or the financial institution that offers the lowest overall net interest cost to the library. And so we have that sale, have the auction, discuss the results with the library, and then the library gives us direction to award the sale to the winning underwriter. So in this case, when you have a negotiated sale, you can choose to, or in another case where you have a negotiated sale, you can choose to work with a bank. Perhaps it's a bank you have a relationship, and by bank I mean a larger financial institution, one of the major players, where they're going to buy the bonds and then reoffer them and basically sell them to other entities. And to the extent that they can't do that, then they have to underwrite whatever's left. And so that's really the difference. And in this case, when you have a negotiated sale, you have a little more flexibility in timing of the sale, and it's somewhat smoother in some aspects, but it's more difficult in others. And so let's take a look at this slide and the next slide that looks at the differences and considerations that you might want to think about for choosing whether you go the competitive route or a negotiated route, again, only for a lease financing. So we're going to look at the types of security. In this case, for a negotiated sale, you're probably going to be looking at more speculative securities. And again, since this is backed by property taxes, you're more likely going to look at a competitive sale. But the other items that you want to look at are you going to need a rating? Are you a pretty stable, frequent market participant? So again, you'll be looking at the rating. You'll be looking at what type of issuer you are. Again, frequent or infrequent. Is the market familiar with you? If it's not familiar with you, maybe you want to negotiate this with a bank. And then issuer characteristics. What is your financial position? Is it pretty stable? Are you showing growing reserves over time? Or are you having some political or legal problems or financial problems there? Again, the more speculative in nature that the issue is, the more likely you might head down a negotiated path. And so market conditions also play a factor. We as a municipal advisor are tracking both competitive sales in real time and the negotiated market. And so we look to see what's going to get the library the best deal. Depending on the time of year, if we're closer to the end of the year, it may be that it might make sense to go negotiated, because as you move towards the end of the year, a lot of banks are filling up their books, so to speak, with bonds, and so the interest rate ticks up higher. And sometimes in those cases, it makes more sense to go with an underwriter and a negotiated deal. Bond structure is another important element here. Most of what you're going to be issuing, in my experience with a library, is, I would say, a vanilla deal. You don't have a lot of debt typically, as a school might, so it's easier for banks to understand what that is, since it's probably going to be wrapped around maybe one or two other issues, and a competitive sale might make more sense. But if it's complex, again, it might be easier working with an underwriter and negotiating that. There are some other factors here that we would look at, and while it's complex, whether it's interest rate risk or underwriter's fees or underwriter risk, these are things that you don't necessarily need to know and have when you come to talk to us. These are things that we're going to help walk you through and really understand your situation so you can make an informed decision. But it is your choice and not the professionals in terms of how you sell this, unless, of course, I mentioned it's a general obligation, then the answer is pretty easy there. So once we've determined the type of sale that it's going to be, and we have either the competitive sale or what we call in terms of negotiated sale, the pricing, we've got to finalize that official statement, finalize that final document. So all the information in terms of interest rates, yields, and prices on the bonds will be included in that final document. So, and that will basically be the entire change. So you'll have those yields. You also have, if there's any change in the size of the bond, perhaps interest rates came in very low, and we were able to increase the borrowing if that's allowed to accomplish more projects. That's possible as well. But all that information goes into this final document, and we include the final rating. By that time, we'll know certainly what the rating is, and we only have from the time of sale about 7 business days in order to prepare this document, get it to the working group, and then for review, and then get it back out to the underwriter. And then this is the closing slide, but I'll let Jane talk about it.
Yeah. So as Ryan mentioned, after the sale, you'll know who the buyer of the bonds are. We'll have the interest rates. All the costs have been clarified at that point, and we would put together all the closing documentation that then your president and secretary of your library board. If it's a lease deal, you'd have president, secretary, and treasurer of the leasing or building corporation sign documentation, and then we would get to closing. Ryan and his team or the financial advisor would put this kind of closing statement together in more of a letter number form. I'm a picture person, so we also put together a slide that looks like this, or a variation of this, and it shows you at the top there the face amount of the bonds less the underwriter's discount or their fee, and then the amount to be wired. It then gives information about which accounts at the trustee bank the money goes into and what each one of those accounts are for. In a lease financing, you'd also be paying for the purchase of the real estate, and that's a transaction where the library deeds to the leasing corporation the portion of the building or your library building, and in exchange you get payment for that. So in this example, the library received $1,761,000 for purchase of that leased premises or mortgaged property. That's not extra money. That's money that has been part of our budget all the way along, and so we give the library some of the work to do with that $1,761,000. In this example, there was also a note, an interim financing basically that was issued, and then you pay off that note at this time as well. This is a pretty complicated schedule for a library, but it's an example of a closing for a lease financing. If it's a general obligation bond, it will be a little bit more straightforward. We would walk you through this prior to closing so that you understand where the money's going to be deposited. Ryan and his team can help you with investments, and then the construction starts. So those are happy days. Have another slide here on arbitrage and rebate. We won't spend much time on that today. Generally speaking, if your library is issuing $5 million or less in a calendar year, in tax-exempt borrowings, you can keep all the earnings that you make on the investment of the bond proceeds. You don't have to worry about calculations or sending money back to the Internal Revenue Service. If your project's larger than that or your borrowing's larger than that, then we would try to find some other exception to rebate, and one that's fairly commonly used is called a 2-year spend-down exception. And it basically says if you spend the money in certain ways and spend it all within 2 years, again, you can keep the earnings. You don't have to do any kind of calculations or send it back to the Internal Revenue Service. These are all things that Ryan and we would work with you to make sure you know what your IRS or Securities and Exchange Commission obligations are going forward. And with that, that's our information today. We have a few minutes left for questions if anybody has any, or I didn't know if the State Library folks wanted to allow people to ask questions or just in the chat box.
Yes, folks are welcome to type in the chat box, and I believe there is also the option, it should be at the top of your screen, to raise your hand if you would like to also speak to the presenters.
So any additional questions, we would be glad to answer them. I see Lisa's typing. Or maybe Letitia's typing. Well, as you look at these materials, please feel free to contact either one of us. We would be glad to answer your questions in more detail. Today was really designed to give you an overview and hopefully make sure or allow you a little bit more information with which to frame your questions as you start to do your planning. I think one thing Ryan and I would always tell our library clients is that you can't start too early on the planning phases of it. Sometimes we get together at that working group meeting and have a plan, and the plan maybe is that we don't get back together for another year. Maybe you work with your community or you work with your architect doing some of the legwork, where then we all come back together at a little bit later time to actually start the legal steps or the financing steps. So there's never too early. Sometimes there's too late, especially as Ryan said, as tax rates drop. So thank you very much, and thank you all for your hard work. We really love libraries and like working with you a lot. So thank you all very much. Appreciate it.
Jane and Ryan, thank you both so much for sharing your knowledge and experience with us today. I know it was very helpful for my own understanding of the process, and I'm sure that's the case for the rest of the attendees as well. And again, here you can see their contact information if you have any questions, and your LEUs are available to download there in the window. An archived version of this webinar will be posted on the State Library's LDO Workshops page as soon as it's available. And everyone stay safe and have a great summer. If you aren't already signed up for the budget workshop in June, I think the workshop on the 3rd of June is pretty booked already, but the workshop on the 16th is still available for you to register. So if there is nothing else, then I think we're done for today.